G'day everyone, welcome back to another episode of the Australian Property Investment Podcast. Innovation in home lending. I bang on about this probably because there's a lack of, but when you kind of pull it apart, there's different product segments, and I'll give you some context. So you've got bridging loans when someone's trying to buy before they've sold. There's bridging loans come into place. There's reverse mortgages for people that are kind of later in life and want to pull out the equity while they're still not working as well. You've got things like construction loans and fairly standard in terms of lending. But what I talk about innovation is, why don't we think a little bit more progressively? Why don't we have more banks offering, say, 40, 50-year loan terms, or be able to pull out super, for example, to buy your first home? And this becomes part of this, I guess, home affordability, home ownership discussion and conversation. Now, I know a lot of our audience listening is property investors. This conversation is for us as well. And I want to introduce you, Beth Comino. Welcome on. How you doing?
Good, thank you. Thanks for having me.
Thank you, mate. Now, I had the pleasure of hearing you talk recently at one of our our industry events as well, and I've seen you on LinkedIn.
Okay,
and it's kind of I've been intrigued from afar. So for us to have a chat, I feel like this has been a long time coming. So Thank you very much.
No, it's
the good. Operation that you run, the business that you run, is called Home Affordability Solutions.
Yes, that's
has
as we'll
much
call easier.
Yep, has as we'll call it from this point onwards. And I mean, we've had James from Own Home come on, and I guess there's a place. Helia Mortgage Insurance. There's a place here that exists for trying to get people into the market.
Absolutely.
Which is where you come in, and we'll come to what Has is in a second.
Great.
I guess most people would be more intrigued to know is, how do you become a mother to 4 kids and still look as kind of fresh as you do?
Thank you. Makeup.
4 kids. You got some teenagers there and kids in the mix. We'll talk about yourself personally and professionally. But take us through your journey to get to this point. In life.
Well, look, I'm one of 4 girls myself. So grew up in Gordon, North Shore of Sydney.
Yeah.
Basically went to an all-girls school. I was a middle child with a twin.
Yeah, nice.
And sister.
Yeah.
So if you see me and I don't say hi, it's not me. I will always say hi. But really, I was very independent from day one, right? I remember getting the newspaper articles or newspapers when we used to get them.
Yeah.
And circling the job ads at 12.
Nice one.
And just trying to, how can I earn my own money? How can I be independent? All that sort of stuff. I moved out at 18 as well, even though I had a very comfortable lifestyle at home in the North Shore, as you can imagine. I was very much, I need to make it on my own. So I moved out at 18 and straight into the rental market. So was working multiple jobs. I actually studied fashion for a while. So
hence the get up.
Right? Actually thought I would end up in fashion or something creative, but did that, and I always did administration as well. So always stuck in that very much. I love my spreadsheets. I'm a bit of a nerd on that sort of side. My kids tease me on that always. But we moved out, all that sort of stuff. I got married very young, fell in love very quickly. Yeah. So had relationships before, but when I met my husband, I just knew he was the one. We dated for 3 weeks and then he proposed. So he obviously knew I was the one as well. Yeah. 3.5 weeks. He will correct me. 3.5 weeks.
Because there's a difference between
there's
3
a huge
weeks and
difference,
3.5 weeks.
Apparently. Yeah. Apparently. So we got married and I was 21 when I got married.
Yeah, right.
And the big plan was 5 years. Then we'll wait to have kids. We were going to have, the dating time and everything. Yeah. 6 months later, I was pregnant with child number 1.
Wow.
There was no stopping that one.
Yeah.
So I, had child number 1. I was trying to be mum at home. Now, keep in mind that I was very independent, very career-driven from a very young age. Being a mum at home was not simple for me.
Oh, it's a massive transition.
It's a huge transition, and being very young as well. Most of my friends were just entering the workforce. They were, finding themselves, and I'm at home with a kid.
Yeah.
So I actually started my own business at home, and I was working part-time in finance at the time as well. But the business I started was in fashion. So created my own clothes, designed, made the patterns, everything.
Wow.
Whilst being at home with kids.
Yeah.
Basically, I did that until my 4th child, pregnant with my 4th child. And what was happening was, as you can imagine, little kids at home and sewing is not a good combination, right? So basically I was trying to be an at-home mum during the day and being all involved, and then at nighttime sewing. So burnt out doing that. Passion was gone because I was just burning the candle at both ends, and really just channeled into the finance instead, which was another passion of mine.
Okay.
So always been there, but that's really how I was sort of forced into finance over fashion, I guess.
Yeah.
I still like to dress up. I still like to make that important side of it as well. But for me, you know, where we lived in particular, like I just saw a lot of people struggling getting into the housing market, that sort of stuff. I remember talking to a friend about a budget, and he was like, I just don't get it. I'm not saving any money. And I went, well, let's actually have a look at what you're spending your money on, right? So I mapped down everything that he was spending his money on. He was spending twice as much as he was earning and had no idea. And that just floored me. And I just thought, aren't people aware of what they're spending? And I sort of had taken that for granted because I was so young, we'd, you know, started out with young kids. I was forced to do that.
Absolutely.
I had to. I had to do that.
I mean, you probably got one income at the time. And
So, when I was looking at that, I'm like, mate, how are you? Like, what are you doing? And, you know, that was just something into me of like, there's just this education that needs to go out there, your basic budgeting. So that I just remember there was a pivotal moment for me of, hey, guys, you got to wake up. There's a way to actually do something. There's no excuse of, you know, costs and everything. There is, where there's a will, there's a way.
Spot on.
Right?
Spot on.
So there's my history.
Yeah, nice. So how do you then come to set up Housing Affordability Solutions? Like how does this transition happen, and how do you then enter this space?
Yeah. Okay. So work with my dad.
Yeah.
So it was his little brainchild.
Okay.
He looked at how, you know, mum and dad can help their kids get into the property market, right? So really it's funny because my mum's very creative. My dad's very analytical. Like he's an actuarial, very bright.
Oh, right.
I've managed to grasp onto both, which is wonderful.
I think as a middle child, you probably do that a little bit. You get the best of both worlds.
Have to,
So
right?
I'm a middle child as well. And I feel like you get the best of both worlds.
And a twin, you've got to be like some sort of force in there.
Yeah.
I just, you know, worked with him. Him and I just work amazingly well together.
Oh, nice.
We've always been very frank with each other, meaning if it's not working, if something, you know, if we don't agree with something, we bring it up. We assess it then and there. You know, we're family when it's family time, business when it's business time.
Yeah.
But, so that's how I got into it, essentially. But, now I'm running it. So
Wow.
that's where it is.
Great. So like I said, this is going to be a concept that I hope we can do justice. It's probably something that people need to go on a journey with, because I mean, when I heard you on a panel recently, I'm looking at this and we caught up quickly afterwards. I'm like, explain this to me in a nutshell. So for the uninitiated that are just, you know, discovering this for the first time, take us through the nuts and bolts and how this works.
Yep. Okay. So basics on the home lending side, we come in with a deposit boost, right? So it means we looked at the challenges that people have in just saving that deposit.
Yeah.
Right. You know, when you're trying to avoid LMI, you're trying to, you know, cover your costs, everything, just saving 20% or even 5% can be challenging for people, right?
Yeah.
So we looked at how can we actually mitigate this? How can we make sure that we're not only helping people get into the property market, but there's the bank of mum and dad, right? Yeah. So everyone's talking about it. There is the bank of mum and dad, but what does it actually mean, right? Now, if you're looking at traditional bank of mum and dad, that means that mum and dad are giving you a loan themselves, giving a cash injection, a stat deck. And what I'm always worried about that one is today it might be okay, but in 5 years' time, mum and dad might need that money back.
Spot on.
And they might want it back, right? Or, you know, they'll be coming to you and asking for that money.
Well, the other challenge when you do a stat deck is if it's a and so some banks want to see it as a non-refundable cash gift.
Yes.
Now, if it's a wink, hey, you got to give us this money back, and there's a relationship breakdown, for example, that's actually a gift. Yeah. That ship has sailed.
Yeah.
And you've
got that stat deck there.
Correct.
But then you've got that awkward conversation.
Correct.
Right? So the person or the child that has taken that stat deck actually doesn't have to pay them back.
Correct.
But they still have to have that awkward conversation.
Yeah.
Right?
Yeah. And I've spoken plenty of times about family and money. Like there's a right way to do things. Yeah. There's a respectful way to do things when it comes to family and money. Usually the cleanest way is a guarantor.
Yes.
Borrow the equity, for example, pay it back, the loan's in your names. Now parents freak out. I'm like, no, the current affair is like the 0.01% of bad stories that go on.
Yep.
And then mine will always go to the worst case scenarios, which I mean, as a parent, you typically will do that.
And you should assess that as well, right?
Correct. But then the upside is we haven't had to shell out cash to help our kids get into the market.
Yeah. Well, yeah, so there is that family guarantor as well. The challenges with that one is, let's say mum and dad want to downsize.
Spot on.
Or, move or whatever. They're linked to that property.
Yeah.
Right? So they actually have to remove that second mortgage that's on their home. A lot of parents don't understand that that's what they've done.
Yep.
They go, yep, I'm definitely helping my kid out, and that's great. But they don't understand the implications that are on their own home as well, right? So there's all these challenges. And if there's not enough equity in their house to support multiple children, they have to choose a favourite.
That is exact conversation that we had before. So anyone listening will go, yeah, I've heard something similar. We'll go, you do it for one child. I mean, you've got 4 kids.
Yeah.
You do it for one, you got to do it for all 4.
I have to pick the most favourite child or the one that I know is going to succeed, and I am not
and as
having
parents,
that
we don't have favourites, right?
No, I don't have a favourite. I have a least favourite of the day.
Well said. Yeah.
But yeah, so sorry, I don't remember the question.
Yeah, I guess we're trying to pick this apart to go, how does this actually work? And so take us through HAS in a nutshell.
Okay, so basically we looked at, mum and dad supporting the kids and how do we mitigate that risk. So we just talked about all those risks that are there, right? You've got the kids that are trying to get that 20% deposit at the same time. So rather than mum and dad giving the family guarantor or doing a cash deposit or a stat deck, wink, wink, what we've done is mum and dad invest into a property trust, right? Okay. They're investing into an entire portfolio of properties and they're getting a return on every single property, right? HAS stands between mum and dad's investment and the kids owning the home. So when I look at the kids, what they're doing is they only need a 2.5% deposit. Doesn't have to be genuine savings. HAS comes in with a 17.5% boost. So we reach that 20% deposit that they need. And
through the trust. This is that's coming out of the...
Yeah, but it's a HAS facility. So it's, comes from the trust. HAS stands between the trust and the kids. Yeah. Right? So the kids are only dealing with HAS. They don't need to deal with the investment side at all, right? And then it's a standard 80% first mortgage. So the security we hold is a second mortgage for that 17.5%. It is shared equity. So I say that with hesitation because it's not shared equity as people know it. Okay. Right? So I don't know. When you think of shared equity, do you think that person's owning that home with you?
Yeah, more recently it's like the government is helping and going, we've both got skin in the game, but in the upside, we split the upside.
Yeah, that's right. Yeah. But they're actually, it's Mr. and Mrs. Smith plus government own your house. Yeah. Whereas with HAS, it's Mr. and Mrs. Smith own the home, our security is the second mortgage. That's it. So if you want to do improvements, if you want to do anything with that house, it is your house. It's not ours. Like you've got to see it as, I always say the big brother, but really I'm big sister, helping you get into the house. It's an investment into the house, right? So we're investing with you. We're investing in that individual as well as that house, right? We're servicing them on the basis that they can make the repayments on that 80% and the HAS facility. Okay. Now that HAS facility is only a 3.25% interest only facility. So that's fixed for 5 years. So it's a low interest rate, especially when you're looking at interest rates of about 7% or higher. Yeah. Well,
especially over 90%.
Exactly. Yeah. That's right. So this is where we kind of go, look, we're not only giving you a cash injection, we're actually standing with you and we're helping you establish yourself into the property market. Like I look back at first home I bought when I was 24, was pregnant with the second child. My husband was the only one with the dependent income at the time. So it had to be under 50 a year that we were earning, right? So not much. Yeah. Interest rates at the time were well over 7%. Didn't have that deposit. My dad went, I think you should buy a home. And we went, you've got to be kidding. There is no way we can get a home. And he goes, yeah, you definitely can. We ended up buying a house in Western Sydney, not a great suburb at the time,
in the market.
but the property projection, like the growth in that area was definitely well worth the investment, right?
Yeah.
And you've got to see when you're buying a house, it's not just today, it's tomorrow as well. You've got to look at, what is the growth in this property? Anyway, we bought that house and with the help of brother-in-law with the deposit, which was amazing, and not everyone has that, but he helped us in. But what was a rude shock was all the repairs and everything that we needed to do once we moved into the house, right? So great, I got my deposit. Now I'm running the water and it's all the pipes are rusted, so it's brown.
Yeah.
And now I've got to repair all the pipes in the house. Where am I going to find the money for that, right? And it is such a rude shock for people to go from renting where it's the landlord's problem to all of a sudden now it's my problem.
Yeah. Oh, I mean, I said, you're at Bunnings every weekend, usually. Multiple trips to Bunnings on a weekend because you forgot. And this is all new. They're all new challenges when you come up a home. And there's a sense of pride that you got when it's my home. I can do it, repairs on it, not have to ask the property manager or the landlord for permission. It's a double-edged sword, though. It's where do you draw the line without over-capitalising or going nuts or making mistakes on your home as well?
And I just, we've factored that into our facility, right? That it's like the reason I brought that up is we actually include the first 3 years of the HAS facility within the facility. So repayments, right? Okay. So it means for the first 3 years, you're only paying that 80%, which means lower repayments, obviously. We've serviced you on the basis that you can make the repayments on the 2 facilities. So we recommend you throw as much as you can into that first mortgage for the 3 years. But if there are repairs and things that come up, it's not so daunting, right? We call it that establishment period for that reason. It's really, hey, let's help you get in. Let's help you establish yourself. Let's make sure your house is actually good because we're investing in it as well, remember. We want to make sure that they can do those repairs. We're not setting them up for failure. And then it's, okay, like we work with brokers. So the way you can access the product is through brokers. So we want brokers to be talking to their clients about those budgeting tips that I was mentioning, all that sort of stuff. It's not just get you in a home, good luck. It's, all right, you're in, let's establish yourselves and let's talk about that next opportunity as well. And that's where what's wonderful about our product is it's not just for first home buyers. Yeah,
and this is the part that's why effectively talking to property investors.
Yeah.
So how does this work? So I'm a property investor, for example. Yep. How does HAS come into play?
Same deal. Absolutely same deal. So basically the 80% is the only difference. You're getting an investment loan for the 80%.
Yeah.
That's it. So the HAS facility remains the same. We still include the first 3 years of repayments. And what's great for investors with that is you're a landlord now. You may not get tenants straight away. So you're only paying 80% for 3 years. You've got a little bit of grace period there, right? Or repairs, whatever. You can apply that to that house there. So you can do that. Still only need a 2.5% deposit, your stamp duty fees as well. But yeah, it's the same, and you can just keep rolling it over and over as many times as you want.
So then, and when we had a chat, so I was very hesitant to ask, what's the catch? Or and I think that's the cynicism that comes when we have like innovation.
Everyone asks.
Innovation in this space. It's generally like I said, bridging, reverse mortgages. Like, well, dangle the carrot. And then you're like,
sounds good.
And I think that's maybe it's the Aussie in us going,
totally.
Sounds too good to be true. What's the catch here? And I think we've got a really high level of like a BS radar.
Yep.
Obviously, you've tried and tested to have a financial service product. You've got to jump through multiple hoops.
You really do.
So, I'm just curious to go, okay, so how does this play out when someone wants to go through?
Really, we've tried to make sure there is no catch.
Yeah.
Right?
You run a business, right? So there's some level of commercial in here.
But it's not just a business for my game. That's the other thing. Like we are very much for not only helping people get into property, but build their property portfolio as well.
Okay.
Right? If I was to put a catch on it, it's shared equity. So that means low interest rate in return for a share of capital growth.
Okay.
So when they refinance, they have to pay out a portion of that capital growth.
Okay.
Right? So we give full disclosure of that from the beginning. We make sure that people understand that. There is a minimum capital growth as well. So let's say the property doesn't grow in value, right? So let's say it's been 3 years, you've got $1 million property. There's a 10% minimum growth that needs to be applied. So
over that 3-year period?
Over that 3-year period.
Okay.
And it's capped then, right?
Yeah.
So $1 million property, 10% growth, that's 100,000 capital growth that they need to assume has been applied. If you've got a 20% has facility, because that's the other thing, we can go up to 37.5% in the has portion, but that's a whole other conversation. Okay. Let's just use 20 to be simple.
Yeah.
When you go to refinance, you'd be paying out that original has facility plus 20,000 of that assumed capital growth.
Okay.
Right?
So 20% of the capital gain uplift.
Yes.
Yeah.
Yeah. And if it's gone up by 11%, then it's 20% of that.
Okay.
Yeah. So that's the catch.
There's a 20% shared equity component is what you're working towards.
Yeah. Whatever your portion is, like I said, it can be as low as 10%. It can be 37.5% as well. So depending on the property, that kind of thing. We had a look at that and went, all right, well, realistically, if we've got a 3.25% interest rate and there's a minimum capital growth of that 10%, on a property of about 750, you're looking at an interest rate of just over 5% in that 3 years, which is still so much better than the interest rates that you're spending right now.
Yeah.
So that's where we want to actually meet with the client, with your broker still, to explain that to them. So it's not a rude shock when they go to refinance.
And here's the thing, it's a bit of a win-win because you maybe couldn't have got into the market. You've got in the market, you've had the uplift.
Yeah.
You've got to pay homage to someone that helped you get into the market.
Correct. And that's not going to has. That's the other thing. So it's going into the investors.
Okay.
So whoever's supported you is getting a return on their investment.
Right.
So that capital gain, a lot of people go, oh, hang on, so Has is taking 20% of my capital growth. I'm like, no, I'm just the middleman. I'm here making sure that, mum and dad aren't involved in your purchase. Like, they don't have to be a guarantor or anything. It is just an investment vehicle for them. That's it.
Right. And so investors come in.
Yep.
Then they get a return on their investment.
Yep.
And it's all kind of
and we just stand between the two. So, we look at, like, I'm on the has side, so I'm looking at the credit side.
Yep.
So, they only need 2.5%. So for a client to qualify, they need a 2.5% deposit. Doesn't have to be genuine savings. So as long as you can say, you can prove, I will have these funds at settlement, great.
Just give some context when we talk genuine savings.
Yes.
Some of our investor clients may be more aware of it, but generally the bank wants to see 3 months worth of savings, patterns, history, or that show a rental ledger that shows
Correct.
you pay on time every time, or it's sold a car, sold some shares, sold some crypto to then realize the deposit. You don't necessarily have to keep it there as like 3 months or whatever the genuine savings requirement is.
Yep.
You go, right, I've got a windfall of cash. Maybe it is even cash from parents to go, this is all we can give you.
Exactly.
And it's right, now we can rock and roll, we can go to the races and buy property.
That's it.
Yeah.
And with us, because we're not on title, people can still qualify for government grants as well.
Right.
Right. So if they are a first home buyer and they manage to fall under that criteria for whatever, they can use that towards that deposit as well. So they need that. They must be able to service that 80% facility plus the has component.
Which is where that responsible lending component comes into it, going, we're not just going to kind of come in underneath and give you the extra deposit.
Definitely
you
not.
actually have to be able to, it's almost like the guarantor loan. You actually have to service this component.
You need to prove that you can service it, that you can actually make these repayments.
So very much we're bridging the deposit gap. We're addressing that issue.
Yeah.
Yeah. Yeah.
But another fun one for you is we work in the refinance space as well.
Okay.
Right. So you've got all those clients that came in at 2%, or home buyers that came in at 2%. maxed out their borrowing capacity at the time when the servicing buffer was a lot lower.
Yeah.
A lot of them I'm seeing have gone, I've got the taste of a loan and now I've got a car loan, I've got a caravan, I'm doing all this, right? So they've maxed out their borrowing capacity as much as possible.
Yeah.
And now the interest rates are a lot higher and they can't make their repayments. So we're all about keeping people in their homes, right? What I'm hearing are people are selling and going into the rental market, which is already strained, right? If you sell your property, you're not only losing any government grants or anything, you've lost your deposit. You're starting from ground zero again. So with us, you can refinance, consolidate debts. Doesn't have to be a brand new purchase, but it will just give you that bridging, that period for that 3 years to sort of regain control of your finances. Like obviously you do need equity in your house to do this, right? So it's not just a matter of give me a call and I'll consolidate all your debt. You must be able to maintain or retain 2.5% equity in your own name. But it's a good solution for people that, just need that little bit of support. And it could be the difference of selling your house and keeping your house. So I'm enjoying that one.
Yeah, nice.
Yeah.
And you mentioned, primary distribution for this type of product is through mortgage brokers.
Yes.
We were at a broker event.
Yep.
And I'm looking around the room and I could see eyes glazed over and brokers scratching their head, trying to get their head around it.
Yep.
This is me. I've had to do some research for our chat. I heard you talk. We had a quick conversation. This type of education, it's a bit of a journey. So if someone's listening to this the first time, their mind's going to be a little bit blown. Yes. It is a real paradigm shift to go, someone's enabling me to get into the market. The competition effectively for this product is, like I said, own home, LMI, government schemes or grants, for example. But there's obviously for you being in business, there is a time, a place and a right client avatar, call it, that this product is suitable for.
Yep.
Take me through some recent case studies or recent examples of people that you help. So I guess we can connect the dots to go, I know someone like that, or that could be me in this situation, whether it's owner occupied or investor.
Yep. Look, it's so versatile and I know that's the most annoying answer, but really we're looking at middle income earners, right? Okay. So you look at the high income earners, their own home is a great solution for them, right? You've got low income earners, first home owner grant.
High income earners, I'm not sure you saw, I think it's ANZ that do like the 5% no LMI for certain postcodes.
Yeah.
I'm like, we're talking $2 million loan amount, so they got a 5% deposit. And I spoke to a couple of brokers. They're like, I'm doing a few of these. I'm like, what clients are you meeting that are earning some insane dollars that don't have savings?
Yeah.
But there's obviously, again,
which is concerning in itself, right? But
they're happy to take the risk. And this, I guess, it's risk appetite.
Yeah.
But I guess they're happy to do it. But keep going.
Yeah. So, we are targeting those middle income earners, people that can pay their rent. They don't qualify for first home owner grant, LMI waivers, that sort of stuff. They just fall outside of those categories, right? People re-entering the market. So we're dealing a lot with divorcees.
I was about to say this becomes a big one.
Yeah, it's huge. It's not funny, but when we started, we've been around, has been around since 2016, right? The product itself, a lot longer, but has 2016. When we started out, it was first homeowners. And it's been picked up majority, like most people, divorcees. And the best story, which I will share, is divorcee comes in, gets support from family, he gets into his home, right? He's loving it, finally being able to, lost everything with the divorce.
It's security that they're looking for at this point.
Yeah, it is. And he's got that good income. There's no reason why he can't get a loan. It's just that deposit, right? So he gets in, has great success with it, decides to go again, do an investment property. Not only does he do that, he calls his ex-wife and goes, hey, you have to get onto this as well. And we've now done a loan with his ex-wife as well. So I'm just looking at it going, he's seeing the fruit of it, right? He's, this is someone that
that's the mother of his children. So naturally you want to see them do well.
Of course, but not everyone does that.
Not everyone does,
No, but it is a market that no one's really looking after, right? let's say, there's the grants where if you've bought
10 years.
within the last 10 years.
So if you're listening to this and you go,
qualify.
what are we talking about here? There's a government scheme, one government grant that says if you've been out of the market for 10 years and you want to re-enter, they'll do like a lower deposit to get back in. I think it's over 55.
Yes.
There's another grant there as well. Again,
there's quite a few.
Yeah, we're talking like specific segments of the market.
Yes.
At this point, yeah.
And there's it's limited, it's means tested, the type of property you're getting as
Correct.
well. With us, it doesn't matter.
So income doesn't. I mean, it's not too.
Well, obviously you need to be able to service the right.
Yep.
But if you're earning over a certain amount, that's okay.
Yeah.
Whereas with these grants, they cap at a certain
income level.
Yeah.
So income level and purchase price level, which
correct.
knocks you out.
Yeah, and in Sydney in particular, it's almost impossible. So I'd say the divorcee market is definitely our strongest market, unintentionally.
Yeah.
But it is, that hero story, right, where we're helping people get into the property market again. I think I did share that one story of that couple that were living in a caravan at that broker thing.
Yeah.
I love this one. So they were convinced they'll never be able to purchase a home, right? And it was actually her brother-in-law that went, hey, you've got to get onto this. They got this support. They were able to purchase a home. So move out of the caravan. They had the 2 kids. The oldest was on the spectrum. Refused to go to school that day when settlement was happening because he was so excited about the house. I was getting calls, please make sure that this is going to settle because he's so excited. I'm like, okay, yep. I can't see anything like going pear-shaped at this point, but okay. And what was great was obviously they settled, they got into their own house, and then 2 years later got a call to say, look, we're thinking of moving, relocating. Could we go again but actually keep our property as well? So we looked at their servicing, everything. Yes, they could go again. They could use the model again. So they were able to purchase a new owner-occ and then keep that as an investment property. Okay. So within 2 years, they've gone from living in a caravan to owning 2 properties, which is huge.
Yeah, game changer.
It's a huge game changer. Same with the FIFO market. For anyone that has experience or is one, great income, but really fun lifestyle until you hit about 40, maybe even mid-40s, and then it's, oh, hang on, I actually need to go get a property now. And we're working with that space as well. So there's been a lot of success there where it's that education again, right? Yeah. It's, all right, well, it might not be ready today. Yes, they're earning that good income, but do you know how to budget? Do you know what to do? Where's your money going? That kind of thing.
It's funny you say that. I mean, you take fly in, fly out, for example. I see this across quite a few professions. And if you're listening and you're on good income and you don't know where it's going, don't be disheartened by that.
No.
But use that as a bit of a wake-up call.
Absolutely.
To go, if you're not good with your money, someone else is because they're taking it off you.
Yes.
And I think when we pop the hood and we're not forensically looking through bank statements to go where this is going, it's more just breaking this down and going, okay, it's probably lifestyle at this point.
It could be Netflix accounts, it's memberships that you're not, gyms that you're not attending.
And then you start there and you work your way up, and then it's like there's a car loan, for $600-700 a month plus all the extra costs, but then it's like a couple of dinners out, a week, for example. And like I said, it just adds up. It's not just one thing that's sitting there.
It could be your insurance premium that you could review. Correct. Again, right? Like little tweaks like that where, you set it up years ago and it's gone up over the time, but now's time to review it. Yeah. It's little things like that.
Spot on. And then you go to the lifestyle component, which is, spending a little bit more on, say, the watches or the clothes. And that's probably where I see it start to come undone, which is you're maintaining it because your income has gone up. When we were probably earning 70, 80K, so then you start to earn, significantly more than that. How do you then cap your lifestyle to go?
That's it.
You're earning $200-300 grand. And you're like, oh, I can now afford to buy a designer handbag or belt or whatever. It's like, but do you actually need it?
Do you need it? It's my budgeting. I have fun money in there. So then for me, I don't feel guilty if I spend it. I know that because otherwise I will just go out and spend, right? Whereas if I've gone, no, I've allocated this amount of money for that frivolity, then great. I don't feel guilty. I know I've put some aside for savings. I know I've got all of my utilities, everything accounted for. But, you know, I've even got travel money. It's little things like that. They shouldn't be something that you're dipping into your savings account for later on.
Yep. Yeah, and we've got to understand the flow of money. And I've got to largely credit, Bernadette, she's probably, my wife, she's probably done a lot of work around this. I was probably the spender in our relationship. When I've started to connect the dots, and this is when I talk, and if you're listening for some time, you'll hear me talk about intergenerational wealth through property. The way that we've broken this down is our income goes towards our living expenses, savings, for example, and then goes into buying assets, i.e. property. Property then delivers the passive income for us to go off and then pursue lifestyle, which is you want to buy a new car, whatever it is, it's got to be funded through the income that's coming out of the income producing assets, such as shares. So it gets to the point you can sell that off, you can take the gain and go off and do something with it. Most people, the modus operandi is I'm going to earn it. I've worked hard for money, therefore I'm going to go and spend it on a new car or a new holiday.
YOLO.
And then I'm going to invest the rest.
Yes.
And you're wondering why there's not much afterwards to invest. It's like you've got to invest invest first. I would say that I'd invest over saving any day of the week. Savings, you're not getting much on your return and it's eroding over time, time value of money. And trying to get this seismic shift in behavior and for people isn't something that happens automatically, but you've got to want it bad enough. So when we're talking about, I'd highly recommend read The Psychology of Money, go through some previous episodes that we've done as well. But to shift gears takes a lot of effort to effectively turn this boat now for people to go, you need to go on a different course and course correct, because if you keep going this way, and the way I work it out, I had a client the other day, 300 grand, I was like, over the next 10 years investing, we're talking about 10 years, you got $3 million plus because your income's just going to keep going up. Yeah. Just let that sink in. The next 10 years, your income is going to keep going up and you've got more money to invest with.
I remember my sister making this comment probably 10 years ago when she just had her kid and they were on one income. And her comment to me was, this is the lowest income we'll ever have.
Spot on.
Right? And that just resonated with me. I went, that is a really great way to look at it, right?
Yep.
Today, I need to be aiming for more. That's fine. And whether that is income or investment or whatever, but what are you going to do with what you've got today to build it up?
Yeah. I think when you're younger, it's a really hard to see. Your brain hasn't fully developed to understand, like, call it delayed gratification or just what the future has in store. It's like, you're 40 and you've made it and it's a time of money. I've made all the errors. Bought the sports cars, I've gone on holidays, I've not invested when I should have or could have.
I've
rented for a long time, at time periods, I've sunk money into the business. Whatever it is.
I had a great wardrobe. That was wonderful.
There we go.
Yeah.
Exactly right. Pick your poison. But it's never too late. It's never too late. And I hope that, to the point that you think you're later in life and you're going, it's too late to invest. Never. And so the aim of this podcast, when I bring guests on like Beth, for example, is to kind of broaden our understanding to go, when you hear someone that puts up an objection like I don't have a deposit, you can go, actually, that's rubbish. I've heard someone that can do that. When you say, someone says, I can't invest in property because I don't have the savings to do that, that's rubbish. Listen to this episode. And so what we're trying to do is take away all the excuses, take away some of the lack of knowledge, because we've had to then, you and I our paths get to cross. So I get to bring in people that are experts in their field, like I say, they're best in breed, whether they're client stories, whether they're case studies, whether they're buyer's agents, whether they're in the finance space as well. That's what we're about here at the Australian Property Investment Podcast. So Beth, I want to say thank you very much for coming on.
Thank you for having me.
People that are wanting to know more will include details.
Yes.
To your website,
Brilliant.
LinkedIn, ways to connect with yourself and your team. Scratch the itch. You ask your broker, they may not know about it. So this is, I'd say, awareness is pretty low. Yeah.
It's key right now for us. So, the education, explaining what shared equity is, how our facility works. We've been around for a long time, but now we're getting the name out there.
There you go. Yeah. So compound, like you've been around for some time, but you're now probably kind of feeling that return on time investment as well. So keep it up.
Thank
work.
you.
No dramas. That's a wrap for another episode of the Australian Property Investment Podcast. Like I say, don't give us a review or anything. Drop us a message to let us know that this hit the spot. Any questions, let us know for future episodes. We're happy to answer them as well. Thanks very much.